Welcome to the 5-1. Welcome to the 15-5-1 larger time frame trading session number 2. We're going to discuss the following topics. Kirk's going to actually go over the 4-hour, 1-hour, 15-minute scan and do some examples on that, and then also the 1-hour, 15-minute, and 5-minute scans. Talk to you about the scanner in relationship to what to look for and what's set up there. Then I'm going to talk about trailing stops, trading transition zones, and long-term scans summary. Starting over. Kirk will cover the 4-hour, 1-hour, 15-minute scans, the 1-hour, 15-minute, and 5-minute scans, and then discuss the scanner a little bit. I'm going to talk about trading transition zones, trailing stops, and then give you a summary at the end. Let's get right to it.
What we want to do is share with you how the scans are set up and what they will do for you. You notice that we have brackets around 3 items. That's on the 15-minute, 1-hour, and 4-hour. That's the same scan. Right below it we have some stars, and you see 3 of those on the 3 different time frames. That's a different scan, but they're all the same. So first of all, we're going to illustrate the one in the brackets on the 4-hour and the 1-hour. And so you'd have your checks out here like this. So this is a trend scan. It's only 2 time frames. And so we're going to minimize this and show you what it looks like. And we're going to start off with the 4-hour time frame. Now I've marked several things here. The 4-hour was okay. It just has to be on the correct side of the 34. And the filter has to be the right color. It doesn't have to be on the right side. It just has to be the right color. Then to get the scan, you just need one more time frame. And so right here, this scan went off. It had to be on the correct side of the filter. And it happened to be a 4-bar, so that would work out well. Now, this is where you have to look at the 3rd time frame. Now, this is the 15-minute. Is what you want the 15-minute to be is a 4-bar on the correct side of the 1534, and it's better if they're all 3 indicators are on the correct side of the 0 line. So right in here would be an entry. Now, this didn't take off very far, and it didn't come back against you very far for a while. Now, this one right here, when it went across, is not a 4-bar, and so that one would not be receive a point where you'd want to enter. Right here, this is not a scan. This is what you're looking for. So I'm going to mark this right here and go back to the 1 hour. So we're just on these 2 bars right here where the 1 hour has given the signal to go along. 15-minute. So that's set up so you could then say, okay, I'll take a trade there. This one, it went up 13 pips sideways for a little ways, and then it came up to a good solid 20 pip trade. Now right here, this one was across, and this one was across in the 4-bar. Both these were 4 bars right here. Now let's go back, look at that 1 hour on the next 2. So it's these 2 right here. The 1 hour was across. Now let's go back to the 4-hour. 4-hour was right here. It was the right color, right side. So right here, there was an entry, and you could have stayed in, but it went about a good 30, 35 pips. And then there was another one that hit right here. This one is a good 15 pip move. Now, on the 15-minute, there's a signal right here. It said you could probably consider taking a long trade right here. Let's go back up the other way now. Let's go to the 1 hour. The 1 hour is across. That's all it has to be, is across. But the 4-hour wasn't the right color. So you would not have received a scan there on the 4-hour. So now let's go to the 1 hour. Same scan. This one, the 1 hour has to be on the correct color, correct side of its own 34. The 15, at that point, it was on the correct side. And this one's where you go to the 5-minute. The 5-minute, there was not a 4-bar, so you may want to wait right here Possibly, if you want to take this one, it would have been right here on this bar. It only went up a little bit, 10, 12 pips, and then it's retracing some. But at least there were some scans on that one. So that's what you need to look for on the 4-hour and the 1-hour scans. So look at this 1 hour. We've already seen where it was crossed. And the 15, we've already seen where it's crossed, because this was the entry time frame. And every time it went across, that was a signal. So those are the signals on that one. Now let's go look at the other scan. Now right here, this scan can be used counter trend or a trend. It'll go off either place. And what it's looking for is the 1 hour. Let's go to the 4 hour. You're looking for the 4 hour and the 1 hour to both be on the correct side of the filter zero line. That's it. The 34 doesn't apply up here. It's just the filters, all we're looking at. The 15-minute has to be an early bird filter. And the 15-minute is the third time frame. And it has to be on the correct side of the 34 and the correct side of the filter across also. So let's go back and look at a different one. On this one, it can be used as a counter trend trade. And so right here, the scan was above the 1 hour and 34, but it went a fresh cross right here. It may have been going down just before that, but it had been right towards the end of it. They're very close to the same. This one was going long. This is going long. That one's going long. That one's going long. This one's going short again. So now we're going to go through these. Edit that out. And so just remember the two on the far sides are going short. The rest are going long based on the 1 hour crossing the filter zero line. The next one is the 15-minute. It has to be the same thing. It has to be a fresh cross, or it has to be on the correct side anyway of the 1534. See right here, it was a cross. That's all you have to look for. And then we're going to go to the 5-minute. In the 5-minute, everything was below, so right in there you would receive the scan. And that went over 100 pips in that move right there. So in this 1 hour, now these next 4 bars are going to be going long because the filter. Now this is counter trend. And this one started out as a counter trend, but it had a nice big move. These you can see went counter trend. Let's see if there's any pips in them. On the 15, what does the 15 have to have? It just has to be on the correct side. Is this one on the correct side? Is that one on the correct side? Let me move it over one more. This one's on the correct side, and that one's on the correct side. Now the 5 minutes, your entry time frame. So on this first one, it was not a 4-bar. And so that would have kept you from getting into this trade right over here. See, the 15 wasn't set up until clear back over here based on what the 1 hour was doing. Then we go to the 5-minute on this one. 5-minute, it was a 4-bar. It's better if it has all across, but there was a possibility right there. Went up and bounced off the 1534. Could have considered that one. This one's a better one right here. It went up and it came down for a negative, little bit of a trade. So these are going to be sometimes hard to trade. So if you take them, expect you'll win a couple, lose a few. Be sure, and if you're doing this counter trend, just realize you need to get out quickly and don't stay in them for very long. Okay, this one was the 15 was right there. The 5 had to be a 4-bar, and it was probably the next one right here before you would have received the scan. It went up about 8 pips, went sideways. It went up a little bit, and so there was a small bit of trading here, but you may want to be out here. This is almost an hour, and you're just sitting there going sideways, so I would say you may want to consider getting out of that one. This is the 1 hour and 15, so let's go back to the 15, and as you see, it's the fresh cross there. and the 5 minute. 5 minute has to be probably right here's the best entry. That one is crossed also. You could have entered on either one of those bars. Let's see, it went up 17 pips, come back to about break even. So you may have got in and then got out. Now we're looking for, it's a cross, it's a 4-bar, and so right in here. It went up 5 pips, come down about 3 pips, and then it took off for a nice 40 pip move, and you could have re-entered for a move there. So you can see that even using these larger time frames, by timing the entry on the smaller time frame, you will have a good high probability trade. Take that out. Okay, now we're going to do the last one. We can see it's obviously it went below. And that's all it has to do on the 1 hour. The 15 minute, we had to wait 15 minutes before that one went below. So the scan would not have even gone off at this point. And then the 5 minute, what does it have to have? At least an early bird filter right there, and it has to be on the correct side of the 0 line and the correct side of the 34. So there would be a scan, and there's a 30 pip scan right there. Another scan would have gone off here for 20 pips. Then here's the big one that the 5 minute would have given you a scan. That went 100, almost looked like 150 pips right there. Now this one I'm going to show you what it looks like on the 1 minute. So yes, in 15 minutes it moved a long way. But see what it looked like on the 1 minute? Just a nice steady, everything was just right. So you could have easily taken out 100 pips anyway. If you did, depending on what size of trailing stop you had, if you had a 20 pip trailing stop, you would have been okay, cleared down to here. Would have been taking you out right there. So 120 pips with a 20 pip trailing stop on that one. And Jed will get into more of that later. So that's the 2 scans. You can use all of them, none of them. You can. The same thing holds true on the 15 minute. So you decide whether you want to use that one on occasion. That is the best one to use. But you can see how the 4 hour and the 1 hour worked out well.
Okay, I want to talk about transition zones and how to trade them, how to manage your trades, and when to know when it's safe to start using the larger trailing stops to manage those trends. And we'll talk about the stops here in a minute, but I wanted to talk about the transition zones. After I got the scan for this particular trade, I kept a tight trailing stop on these 2 trades, 5 pips. And you can see where the stop took me out, here and here. Okay, and that's fine and dandy. The reason being is because right here at this point, the 134 had not crossed the 534. But then when it finally did, after I closed this position, that retracement creates an issue for having a really tight trailing stop, right? So it hadn't committed to a true trend, so I didn't want to put on too large of a trailing stop. I wanted to preserve some capital, okay, and try to get some gains before we actually got bigger moves, if they were going to come. Same thing here with the second trade. It had not crossed the 1534 yet, so I wanted to keep things tight. Okay. Now the value behind this is that you get to see how a transition zone can be traded. The challenge you run into, and you're going to see this, and I'm going to point this out because it is real. It's a big challenge to trade long-term trends when doing trailing stops. Once you're in a trend, you have a lot more flexibility, but during this transition zone, be cautious, be careful. Now, I wasn't able to trade the rest of this trend, unfortunately. I had other obligations. Had I been able to have left my trades on with a larger trailing stop, a 20 pip trailing stop would have taken me out on this particular trade at a 10 pip protection about right in here. 10 to 15. Somewhere in there. Okay, it's really hard to kind of gauge it, but I'm just wanting to show you what I mean. Let me just kind of draw this out. So if my entry is right here, if I have a 20 pip trailing stop and it initiates at 20 pips right, not there, maybe you could have, let's just say that it did. It's going to come to break even. This came back and tested me at 2 pips, so it would have been safe. Pretty risky, but it would have held. Okay, but then it goes up to 27. So if it's a 20 pip trailing stop at that point, we have now 7 pips protected. So let me mark this so we can just follow this transition. I'm going to set these up here. Let me make sure that I get this as close to 7 as I can. So there's 4. Close enough for example's sake. Okay, so that puts me, this mark puts me at a 7 pip protect profit from the entry. Okay, so then it comes back to the 15, it goes up to 31, and then it hits 33. So we are now at 13 pips protection. So I'm going to see if that's about 13. That's 11, almost 12, so let's go 2-ish. Okay, so there's 13 pips protected. So you can see that that's as much as I would have gained in that particular move because it didn't pull it any further. That's a 20 pip trailing stop. Transition zones, there's going to be those pullbacks, and that's why I want to try to get past transition zones before I start trading bigger moves or planning on taking bigger moves and using larger trailing stops. So this is the caveat. Wait till you get past the transition zone so that you can trade larger trailing stops, which is going to help you get less of a drawdown in those transitional periods. Yeah, there's some good movement there, but you got to manage it either manually or a tighter trailing stop. Okay, so let's move over to here. Let's find our next signal. Okay, the next one I'm seeing is right there. That's a 4-bar cross of the 34 moving average. Let's run with that one. Okay, so if we set a 20 pip trailing stop, let's see how much more we would have gained. So let's just say I entered right there. Leave this out of the way for now. And it goes up 8 pips, so it's not initiated yet. Goes down to 6 to 7 pip range. Then it goes up to 26, let's say 20, yeah, let's just say 27. So that's a 7 pip protection. It's about right there, I'm thinking. Okay, so there's roughly 7. Okay, so it goes up to, protects us at 7, comes down to 17, so it still has a 10 pip protection there, or buffer. It goes up 1 more pip, so we're at 8. Let's see if that's close enough. Then we go, it comes back to about a 10 pip buffer. Comes back, gives us that 10 pip buffer again. Now remember what I talked about when we're talking about using this 34 moving average as a guiding line. You can pull this back if you need to manually, just to make sure you have a little bit more wiggle room if it starts to get a little tight, or you can just let it honor it. Okay, those are options you have. Just depends on what the market's doing at the time, determines whether I do that or not. Comes back, tests, then it goes up to 33. So now we're at a 13 pip protection again. If you remember that initial number on that last move up. See how this one holds for us. See if that's 13 or if that's 15. I'll bet you it's pushing 15. Yep. There's about 13. So you can see here that we actually have that 20 pip trailing stop protecting us quite a bit more. See, we can go clear up here to 39, so that's 19 pips. About 19 right there. Okay, 19 to that point, and it comes back. So we still have that 10 pip buffer. Then it comes back here again to a 7 pip buffer. And then it goes up again to 42. So now we are at a 22 pip protection. So we're about right there, is my guess. Let's double check. That's a little bit higher. At 23. Let me pull that back down so we're realistic here. Okay, so there's 22. So our 22 pip protection there, it comes back to 25, so we're a 3 pip buffer. Okay, so a 3 pip buffer. And you can see that it never went higher than that, so we would have been taken out manually by ourselves if we had come back to it, or right here for 22 pips. In any case, this would have been a long-term move in a time of day where it wasn't going to be a heavy mover, and this pair isn't necessarily one that moves a huge amount compared to some of the others. And so this example is probably for you and me going to be more of a typical long-term pattern that you're going to see if you're using a 20 pip trailing stop. There are scenarios where a 30 pip would be better, or maybe even a 40. Okay, I want to talk about psychology of this. When you're trading smaller time frames and you're seeing exit signals on the 1 minute and the 5 minute and the 15, but you're basing your actions on the larger time frame signals, you're going to have more volatility. There's going to be larger swings in the market between price bars, and even some of the characteristics of some of the currency pairs where you get a spread spike or something. Those things are going to happen, and they put your money at risk. So here's what I'm saying. The longer your money is on the table and in action, the higher the risk is of you losing potential gains and or losing that money. Okay, so that's why we have to have trailing stops and protect hard stops to protect our capital. Okay. Here's the psychological barrier. There's a couple things. One, fatigue can tear you down. Okay, fatigue is a big deal. Pay attention to your health. Pay attention to your energy levels. Okay, that can psychologically mess you up. It can blind you. Okay. Number two, when you have those volatile swings in the market, or you get a spike, you can go into what I call, for lack of a better term, market abandonment maybe. I'm not sure how you'd word it, but the whole point is you'll get a nice big run, it'll move 30-40 pips in your favor, but then there's a retracement that comes back and it takes you out for only 10 pips profit. Okay, because you had a larger trailing stop. You have to be willing to let that happen for the moments in the market where it's going to actually move far enough that you get a 50, 60, 70 pip move with that protected with the trailing stop. So be okay with taking smaller bites out of the market with the automation that comes with the trailing stop. Okay, be okay with it. Wrap your mind around that so that you don't feel like the market's neglecting you or you're being abandoned by the markets because it left you in the dust. This is critical. You need to understand. I'm spending enough time on this because I want you to understand that this is going to happen and you need to be okay with it. And I find that if I'm still in the mindset of smaller time frame signals, which you can get caught up in that really easy, get down in the noise of the 5 minute and the 1 minute, you can find yourself closing yourself out of positions when all it's doing is breathing. Inhale, exhale, inhale, exhale. It's not really moving anywhere, it's just breathing. The ebb and flow, okay? So I'm going to show you some charts here, some examples of that very thing that happened. And I'm doing this as an example to show you that it's easy to get caught up in it. And I feel that this is important enough for you to understand that the potential's there, but you have to trust in the signals, trust in the trend, and set that trailing stop and let it do its magic. Okay? Okay, this first chart is the 1 hour pound New Zealand. And we're going to be focusing on this area right in here. You can see that I took several trades right in this area, little ones. And notice how far the market really did move. Okay, so it's really hard to see really what this is. I'm just to give you the illustration of what you're going to see in the market. So I'm going to just scroll up to the 15 minute now. Same pair. I got my 15-minute signal right here, the cross of the 34 moving average, 4-bar pattern, and entered on the 5-minute, I believe, on this one. But it went against me, I think 5 or 6 pips, or maybe 10 at the most, something like that. Took a little hit there. But then I did jump back in and took out another trade right here. Okay, so I made up for the loss and gained some ground, but I was focused on the smaller time frame instead of saying, okay, you know what, I'm just going to put on my trailing stop and walk away. Let me go to the 5 minutes so you can get a better picture of what kind of took place. Okay, took my little hit there, got back in, made some profit. It went flat. This is what I want to see. This is good stuff. Because now I can set my stops based on fractals when I start to get my next entry, or re-enter the market, or just keep an eye on it. But when it does break short, I'm still trading short term here. I wasn't even trading. I missed this mark because I was looking at a different currency pair, but I got in on another signal down here. So I missed an entry up here, which you'll see in the other currency pair. I caught this move, but what I wasn't doing was exactly what I'm trying to teach here, is to back out of the smaller time frames, get to the larger time frames. If you've got a good signal up here, by all means, set it and walk away, especially if you get some profit already tied in. And I'm going to talk about how to do this in a minute. But the actual movement in this market from this entry down to right here was 96 pips. 96 from there to there. There are some add-on opportunities. Now, larger time frames, if you're watching them, this was about a 2-hour period from here to this close. That's how long I was in front of the computer. Could have easily had a few add-on positions in there. You can see I had one here. There's a re-entry, but it could have been an add-on. Could have had an add-on here. It could have had an add-on here, and taken that 96 pips and compounded it. Okay. Let me go to this next pair. This is the pound Aussie. Okay, same time of day, trading at the same time, watching it. And they were so similar in pattern that I could have traded both of them and was not paying attention to which one was which pair, and I wouldn't have traded them any different. They did very much the same thing. But here's the 4 hour. You see the market move right there quite a bit. Here's the 1 hour. 15, kind of a little jumbled up there. Let's get down to the lower time frame so you can see exactly what took place. Here's the 5. Remember that transition? It came out of transition right where I entered the darn trade, and I got caught up in this sideways movement, which is okay. What I'm going to explain here in a minute, and I'm going to give you an example of what it should look like, okay? So that you guys can get a picture of what I'm talking about here. This was my initial entry. this add-on position and this, well, this should have been an add-on position and this should have been an add-on position. This one was, and this one was too. So 1, 2, 3, 4. Oh, there's no one here. 5 and 6. So there's 6 opportunities there, plus some more. But had I stopped trading here as far as manually entering positions and just let the trailing stops work, the larger trailing stops, a 20 pip trailing stop would have gotten me clear to the bottom of this particular move right here before it would have pulled back to close somewhere over in here. Down into here, 108 pips from bottom to top, compounded by 6 different entries. Between these two currency pairs, I figured, based on just what positions I had here, not the what ifs on the other pair, but just these and the ones I did on the pound yen or pound New Zealand, had I left them alone with a 20 pip trailing stop, it would have yielded 603 pips. 2 pairs. And had I just done the pound Aussie, it would have yielded 424 of those. Okay, so this is what I'm telling you. The psychology got the best of me. This is what I want you to get. Don't let it happen. I know that some of you have already reported that you did some trailing stops and they've worked for you very well. Hats off to you. I'm very excited to hear that. Let's go to the example that shows you what it should look like. Actually, I'm going to give you a couple of examples. Here is Peter. He traded with me at the exact same time, and this is what he did. He did it right. And that's what I'm trying to convey here. My mistake psychologically was I was caught in the smaller time frames and didn't break out of it. He didn't. He actually hadn't been trading, so when he came to trade, he was fresh. So he was able to get 3 positions for a total of 75 pips using those trailing stops. And then here is the pound New Zealand, where he took 2 positions for a total of 55 pips. Nice examples. Let me give you one. Okay, here is a prime example of how John is exercising these larger time frames. Now, he didn't initiate a trailing stop. He's doing it slightly different, and this was in the 1 minute chart, but the principle applies. Okay, you can see he's got his stops clear up here at the 1534, above the 1534, and that's his choice to do that. But with the trailing stop, you start to protect these larger positions. But this is what it can look like. This is why I wanted to show you on those larger time frames. Instead of only getting 43 pips, you could have a 0 on the end of that. That's the power behind these larger time frames and using these trailing stops. Now, we've talked about how to use trailing stops a little bit, but I want to go over that a little bit more. Let me go back to the charts really quick, just for the sake of making sure you guys see some real facts here. So I've showed you kind of how you can trail that and manually watch what it looks like and kind of test it to see what we're looking at. But the key factor here is you need to get good at just measuring critical price bars. See, there's a 7 pip price bar. Here's an 11 pip price bar. So you know you're dealing with somewhere between 5 and 10 is your range. When you're trying to determine how to set that trailing stop, you need to be able to measure those and say, well, I don't want it to take it out too soon, but I don't want it to be too far out. What's the overall trend? So you're going to measure those bars, get an idea. Okay, I'm looking at about a 5 to 10 pip range, so let me put it out to 15, or let me put it out to 20. Depends on what the market's doing. But then you need to also measure retracements. See, that's a 20 pip retracement, or you could even come up and say that's a 23 pip retracement. here's a 15 pip retracement. So you need to give yourself those measurements to determine, okay, where's my points to move this. And now you can adjust a trailing stop really, really easy. Not hard at all. You just have to grab it when it's on the line, just like one of these. You just grab it, click on it, and drag it back to a position where you want it to be. And then as it moves again, it'll tick back up. You can pull it back down. And the only time I do that is if I'm in these transition zones. And I know pullbacks are inevitable or highly likely. And so that's one time I do that, and I don't move it back very far. I try to make sure I'm maintaining some protection at all times, but you want to be able to have a little bit of flexibility if you're watching it. If you have to step away from the computer, you're going to go to bed or go to work or whatever, let it do its thing. Okay, don't fret over it. You're either going to make money, a lot of money, or you're going to make a little bit of money. But if you can get it into a protection zone, you're good. Being able to determine what type of a trailing stop to add to the situation depends on, one, am I in a true trend zone right here? This is a confirmed true zone. Okay. Over here I'm in transition. From here to here I'm still in transition. Or I'll clear over into here actually. About right here. Because here this was a downtrend. So from here to here you've got roughly 24 1-minute periods where you are in transition. Now you can trade there, but you just have to know that you've got to be careful. So in measuring that, you get this big spike up. This big spike up is about 52 pips. 55, somewhere in there, right? You know that's the initial move. There's going to be a pullback because we already have these transitional things taking place, right? They're setting up. So we need to take into consideration, okay, that was a big move up. Things are going to get tighter, so I need to just measure my smaller retracements. Measure these retracements, measure these legs, just to get an idea of where that needs to be. Now, you can be in a position, this is what I like to do. I like to set my position, set my hard stop at between 10 and 12 pips, sometimes 15 on the outside, but mostly it's 10 to 12. And then I like to go in and add an automatic trailing stop of 15 pips, just kind of standard. If the market is really, the price bars are really small and the market's not really moving fast, I'll do a 5 pip. But if it looks like there's some volatility and there's some action going on and there's some good angles and stuff on the charts, then the 15 is kind of what I default to. But I adjust that if I think I need to. And one of the things I do is I'll look at fractals. So I'm in this position. There's no fractals to look at over here per se in the past. But what I'll look at is on this next pullback, I get a fractal. It forms a fractal right there. So then I want to start measuring where my price is based on that fractal. So I'm at 20 pips. And I may have a 15 pip trailing stop. So what at that point I'll say, well, you know what? I don't want that fractal to create a ceiling for me that knocks me out at 1 pip profit or at 5 pips profit. It's still kind of setting up. I better manage this a little bit differently. Or you may say, you know what? That's my ceiling. I'll take the 5 or 1 pip move and have a 20 or 15 pip trailing stop. Okay. Those are the options you need to consider. Okay, a 5 pip trailing stop actually worked better in this particular scenario right here because we were in a transition zone. Over here is where you could have had a larger trailing stop, but still, as we pan that out, you still only would have gotten 22 pips out of that trend based on what the market was willing to give you. There are much larger moves that take place, and like I showed in the pound New Zealand and the pound Aussie, they happen occasionally throughout the week. But these smaller moves, these are where even the larger time frame trading is still very valuable. Meat part of your gains is in these types of moves. So in summary, I just want you to recognize, one, the psychology of it. Pay attention to your energy level. Don't allow yourself to get beat up when you're dealing with a pullback or a retracement or a spread spike that takes you out of the market prematurely. Gains are gains. Be grateful for them. Watch out for transition zones. Trade accordingly. And learn to measure those retracements, the waves or the legs up and down, and the price bars. There's no science to this, guys. It's just you've got to get a feel for it. Play with it. But what I want you to do is practice using trailing stops. Even if you're doing a 5-pip trailing stop initially, just to kind of get an idea of what it looks like, what it feels like, or a 10 or 15. Then when you get into a nice 15-minute zone, a 15-minute trend, where it's crossed its 34 moving average and you've got a nice 4-bar in one direction or the other, take it and test out the larger trailing stop. See how it works for you. And you may find that a 10 or 15 pip trailing stop is absolutely sufficient for what you want to accomplish. I do that quite often. But there's some great potential in going to the 20 and 30 pip range on these trailing stops. You can do a 40 pip. Play with them. See how it works. It really is not anything that we can set a hard set rule for. And if we did, it would actually end up hurting most people because the market has its own opinion about what's going to happen. So we want you to just be flexible. And that's probably the biggest takeaway I want you to take here, is to be flexible. Allow the market to move. Be okay with small gains while you're going for those bigger home runs. They will come. My hope is that you'll be able to get more confident in taking add-on signals or even re-entry signals once you have a trailing stop initiated close, because that's where you can compound things. Anyway, I look forward to having some success stories from you. Please communicate with me what you're finding in your trading so that we can know how to assist and guide you. If you're getting stuck, give us a holler. We are making ourselves available to help guide students, and if you're looking for some additional coaching or mentoring, we have opportunities available as well. Seats are limited on that. Our main focus is trading, but I wanted you to know that our approach is to help traders be able to trade well enough that they can trade alongside us and work with us. And we've got a really great bunch of people that are currently doing that, and things are really hopping, snapping, and getting good. So we want you to stay connected with that. Keep coming to the forums, keep coming to the pip clubs, and we will see you on the other side.